Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Coke and Pepsi stock so we can determine if they're a buy or a sell. First, let's discuss Coke. Their products are sold in over 200 countries. You'll never believe this stat, but 1.8 billion of its products are consumed each day. Let's get started with the model. This is a large cap company, 259 billion market cap. They're trading at $60 a share, and they have 4.3 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They have a ton of free cash flow every year. 9 billion in 2020, over 11 billion in 2021, 9.5 billion in 2022, and 9 billion in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's almost 8 billion in 2020. Then it jumps to 9.8 billion in 2021. Then it's pretty steady after that, 9.9 billion in the trailing 12 months. Revenue are their sales, and it was low in 2020 from COVID, 33 billion, then jumped up to 39 billion in 2021, up to 43 billion in 2022. Then it moved up a little bit in the trailing 12 months to 43.5 billion. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 341 billion. We discounted the numbers back to today using the weighted average cost of capital. We get a value of the company of $290 billion. We divide that by 4.3 billion shares. And we get a calculated stock price of $67. They're trading at $60, so they're trading at 11% discount. It's a buy according to the model. Here's their most recent 10Q as of 3/31/2023. On the first page of the 10Q, it lists all their debt, the years the debt is due, and the interest rate they pay in the debt. I can't believe how low these rates are. 1/8 of 1%, 1%, and it's due in 2041. They have the best terms ever. Unbelievable. And it also lists the common stock, ticker KO, par value of 25 cents. Par value has nothing to do with how much a stock costs in the market. It's just an arbitrary number a company applies to each stock. It's so they can easily keep track of the number of shares outstanding. Most companies' par value is much smaller, like a penny or a tenth of a penny. Right in the beginning of the 10Q is their income statement. For the first quarter of 2023, revenue of 11 billion, up from 10.5 billion from last year. Let's get a breakdown of their revenue so we know what it is. Most of the Coca-Cola products you drink are made by another company. Over 6 billion of their sales is from concentrate. They sell the syrup to a bottling company, and that company manufactures the products. It's an amazing business model. There is a ticker Coke, C-O-K-E, which is a separate company. That's their largest bottling arm. And Coca-Cola, ticker K-O, owns part of Coke, ticker C-O-K-E. But they are separate companies. The Coca-Cola bottling company bottles other beverages, not just Coca-Cola. And 4.6 billion of their sales are finished products. Of the 11 billion of revenue, 4 billion is in the US, 7 billion international. They talk about concentrate right here. Concentrate sales volume represents the amount of concentrates, syrups, source waters, and powders/minerals sold by the company being Coca-Cola, to its bottling partners. So they just sell the concentrate to these bottling companies, and those companies deal with all the infrastructure, deal with actually manufacturing the product, selling it to the retail stores, etc. Here's a breakdown of the revenue by country. EMEA, Europe, Middle East and Africa, 1.8 billion. Latin America, 1.4 billion. North America, 4 billion. Asia Pacific, 1.2 billion. Global Ventures, 700 million. Their investments in bottling companies, 2 billion. I think Global Ventures refers to Costa Coffee. Costa Coffee is a coffee chain in the UK. And Coca-Cola acquired Costa Coffee from White Bread. And that was back in 2019. Coca-Cola paid about $5 billion for Costa. I didn't notice, but Global Ventures also refers to China sales. This is a really interesting chart because you can see by location whether they're profitable or not. Total revenue in EMEA is 2 billion. Operating income of 1.1 billion, which is a lot more profitable than North America. North America has double the revenue, and lower operating income. And look how much more profitable Latin America is than Asia Pacific. They both have almost identical revenue, but the operating income in Latin America is about 50% higher, $853 million compared to $563 million. This is the type of due diligence that helps you understand things a little better. Their gross profit is $6.7 billion. That's revenue minus cost of goods sold. So their margins have improved a lot because their revenue only went up $500 million from last year, but their gross profit went up $260 million. So much better gross margins in the first quarter of 2023 compared to the first quarter of 2022. Then you have SG&A, $3.2 billion. These are all the expenses not directly related to generating the revenue. They give a breakdown of their SG&A, $650 million from selling and distribution expenses, $1 billion in advertising, $58 million in stock-based compensation, other $1.4 billion. In the first quarter of 2023, SG&A increased $218 million or 7% from the first quarter of 2022. The increase is mainly due to increased marketing spend and operating expenses, partially offset by a decrease in stock-based compensation. Last year, they spent $87 million in stock-based compensation. This year, $58 million. So it did decrease, but it didn't really move the needle because it's such a small amount. I wonder what other operating expenses are, the $1.4 billion. I searched this dollar amount and I searched this phrase, but they don't give much more info, so I'm not too sure. Operating income, $3.4 billion, very similar to last year. So their operating margins are worse than last year because their SG&A went up a lot. They give a breakdown of operating income by segment. 34% in EMEA, which is up from 30%, 25% in Latin America, 31% in North America, 17% APAC, which is down from 20%. Then you have interest income, $168 million. This is the interest they receive on their investments. So their interest income was $78 million last year. Now it's $168 million. That's an increase of 114%. The increase was driven by higher returns in certain of our international locations. They paid $370 million of interest on their debt, more than double from last year. That's probably due to higher interest rates. Interest expense is up 105% due to higher interest rates on short-term borrowings. Then you have equity method investments. They had a gain of $275 million. Equity method investments are their investments in other companies. If they own between 20% and 50% of another company, they probably use equity method accounting. Let's say they owned a company that reported $100 million of net income for the first quarter. And if they owned 20% of that company, they would put $20 million on their income statement as equity method investments. Sometimes equity investments result in losses if the company they're invested in reports a net loss on their income statement. Then you have other income of $600 million. Last year they had a loss of $100 million. For other income, they recognized a gain of $439 million related to refranchising their bottling operations in Vietnam. They had $940 million of income taxes. The $940 million of taxes is equivalent to an effective tax rate of 23%. Last year it was 19%. The way you calculate the effective tax rate, it's their taxes over their earnings before taxes. It's the only time you don't use revenue to calculate the percent. Their net income is $3.1 billion, earnings per share of 72 cents. They did lower their shares outstanding by 6 million. They currently have 4,326 million shares outstanding. If all the convertible securities converted to equity, they would have 19 million more shares outstanding. They would have 4,345 million. Let's look at their operating cash flow. The way to calculate operating cash flow, you start with your net income of $3.1 billion. Then you add or subtract the non-cash items on the income statement. Then you adjust for changes in working capital. So they only generated $160 million of cash flow in the first quarter. Last year they generated $600 million. That is a bit concerning, it's so low. You definitely want to track this number over time to make sure they have enough to pay their dividend and potentially buy back stock. Let's look at the stock on Simply Wall Street. It's trading at $61 a share. 260 billion market cap, down 3.5% in the past year. The risks are high level of debt and insider selling over the past 3 months. Here's the stock price since 1990. It peaked at $66 in the middle of 2022. The stock went up a ton from 1990 to 1998. The stock didn't go up from 1998 until 2014. It went down for about a decade or so, then got back up to where it was in 1998. Then when COVID hit, it fell below 1998 levels. It finally had a strong breakout in 2020 and 2021. But you do receive a dividend each year, so you do have to build that into your total yield. Here are some news and updates. They should report their second quarter results in about 1 month. Upcoming dividend of 46 cents, yield of 3.1%. Coca-Cola has not managed to accelerate its returns. Coca-Cola versus Pepsi, which is better positioned to sell puts? Here's their PE since 2018. It was really high in 2018 at 82. March 2020 it dropped to 18. That was its low point, and it's currently at 27. Their price of sales is fairly steady, 5.4 in 2018. It's currently at 6.2. Price to book is also pretty steady, 10.2 in 2018, 10.6 currently. Simply Wall Street's valuation is $63. They say the stock is 4% undervalued. 25 analysts priced this stock and the average price target is 69. They say the stock is 15% undervalued. Their trailing 12-month revenue is $43.5 billion. The forecast is for the revenue to be $50 billion by the end of 2025. They are a bit leveraged, debt to equity of 163%. Their debt is $44 billion, equity $27 billion. They can easily cover their interest payments. They can cover their interest payments 33 times. In 2012, their debt and equity were almost identical. Ever since then, their debt has grown and their equity has declined a bit. At their worst point, their debt to equity ratio was 260%. Debt of $53 billion, equity of $20 billion. They do pay a pretty good yield of 3%. Industry average is 2.7%. Their payout ratio is 78%. That means 78% of their net income they give back in the form of a dividend. Their earnings are $2.28 a share, and 78% of that is $1.84. You can see they pretty much raise their dividend each year. It was $1 in 2012. Now it's $1.76. The forecast is for them to pay over $2 by 2015. And the yield is pretty steady, between 2.5% and 3.5%. The forecast is for the yield to be 3.3% by 2025. The CEO's total compensation is $22.8 million. He's been with the company 6 years. His actual salary is $1.6 million. Total compensation is all the benefits. In the past year, there's been a lot more insider selling than buying. The CEO sold 150,000 shares back in April. He sold 46,000 in March, 32,000 last July. 62% of the company is held by institutions, 28% by the general public, and 9% by public companies. Warren Buffett's Berkshire Hathaway is the biggest shareholder at 9.25%. He owns 400 million shares valued at $24 billion. And they've been around a really long time, since 1886. Their employee count has gone down over the years. It was 151,000 in 2012. It dropped to 62,000 in 2017. Now it's up to 83,000. The stock trades in many countries: the New York Stock Exchange, Lima Bolsa, Swiss Exchange, Deutsche Börse, Mexican Bolsa, Zitra, Santiago, EuroTLX, Wiener Bourse, Kazakhstan, Bulgaria, Santiago, Buenos Aires, and Sao Paulo Bolsa. Let's take a look at Pepsi. Pepsi dates way back to 1893. It was actually called Brad's Drinks. And Caleb Bradham only sold the product in his drugstore in North Carolina. They renamed the product Pepsi in 1898. The reason they called it Pepsi is because they advertised it would relieve dyspepsia, which is indigestion. Let's get started with the model. This is a large cap company, 250 billion market cap. They're trading at 184 a share, and they have 1.4 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had really high free cash flow in 2021, $7 billion. It dropped to $5.6 billion in 2022, then dropped again to $5.3 billion in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. That peaks in 2022 at $9 billion, down to $6.6 billion in the trailing 12 months. Revenue is a sales for the company, and that grows each year from $70 billion to $88 billion. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $250 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $213 billion. We divide that by 1.4 billion shares. And we get a calculated stock price of $155. They're trading at $184, so they're trading at a 19% premium. It's a sell according to the model. There are 15 companies in the same industry as KO and PEP. If either of them have a number in red, they're worse than the median. If they have a number in blue, they're better than the median. Pepsi spends a lot more than Coke in CapEx. They spend $5 billion, Coke only $1.5 billion. Both are really leveraged. Pepsi is more leveraged at 2.5 debt to equity ratio. That means for each dollar of equity, they have $2.50 of debt. They both pay a strong dividend. Coca-Cola is a little higher. Coke generates a lot more free cash flow than Pepsi. Both have a very similar market cap. I didn't realize how close their market cap was until I did this video today. Their price to book are both worse than the median. Coke has a better PE. They also have a better price to free cash flow. But their price to sales is much worse than Pepsi. Pepsi generates a lot more revenue, but they don't convert that much revenue to profit or free cash flow. Coca-Cola is much more profitable because most of the Coke products you drink are not manufactured by Coke. They're manufactured by the bottling company. That's why Coke is so profitable. Pepsi's 5-year annual revenue growth rate is 7%. Coke is lower at 5%. Look how high Dr. Pepper is, 34%. I'm not too familiar with Celsius Holdings, but they're at 79%. Their revenue is also tiny, under $1 billion. Let's take a look at their 10Q from the first quarter, and you can see all the debt they issued. Looks like they pay a higher interest rate than Coke, 3.5%, 3.2%, but some rates are really low, 0.4%, 0.25%. Their revenue in the first quarter is $18 billion. Last year was $16 billion. Let's get a breakdown of the $18 billion. Their revenue from Frito-Lay is $5.6 billion, up from $4.8 billion. Quaker is almost $800 million. That's up about 10% from last year. Pepsi is $5.8 billion, also up from last year. Latin America, $1.8 billion. Europe, $1.9 billion. Africa, Middle East, South Asia, $1 billion. And Asia Pacific, $1 billion. Their revenue is up in every category except Asia Pacific. That's down a little bit. That could be due to foreign currency translation. In order to generate the $18 billion of revenue, it cost them $8 billion. Gross profit of $10 billion, up from $8.8 billion. So their margins have improved quite a bit. SG&A, $7 billion. Their operating profit is $2.6 billion. Last year was $5.3 billion. That's because of a $3.3 billion gain from their juice transaction. Last year, they sold their Tropicana, Naked, and other select juice brands to PAI partners for $3.5 billion. So they have to record the gain on their income statement. So they have an inflated net income of $4.3 billion. This year, it's $2 billion. Their EPS is $1.40. Their shares outstanding decreased by 5 million. Now it's 1,378 million. Let's look at their operating cash flow. They had a cash outflow of $392 million in their operating section. Last year, they had a cash outflow of $174 million. Maybe it's just the first quarter is a bad quarter for these types of companies because Coke's operating cash flow was also pretty weak in the first quarter. It looks like they paid back a lot of accounts payable in the first quarter. For example, if they buy plastic or glass for the bottles, they may have bought that last quarter but didn't pay for it, so it's a cash inflow in that quarter, but now they're paying for it this quarter, so it's a cash outflow. Because we saw in their financials earlier, they have lots of free cash flow, and free cash flow is operating cash flow minus CapEx. Let's look at the stock on Simply Wall Street, trading at 184, 250 billion market cap, up 10% in the past year. Here's some of their risks. Dividend not well covered, high level of debt, large one-off items impacting financial results. We saw that earlier with the gain from the sale of the juice company. Profit margin negative 7.5%, lower than last year of negative 12.5%. Here's the stock price since 1990. Its highest point was 194, which was just 1 month ago. So you can see historically the stock just pretty much only goes up. It only had a few dips here and there, but it's pretty much a straight line. It looks really good. Here's some news and updates. Upcoming dividend of $1.27, 2.7% yield. Will shareholders receive a bigger dividend than last year? First quarter EPS and revenue exceed analyst expectations. Their PE was really low in 2018 at 12. It's looking less attractive. It's currently 38. They do have a really good price to sales, is between 2 and 3 every year. Price to book also trades in a tight range, between 10 and 15. Simply Wall Street's valuation is 165. They say the stock is 12% overvalued. 20 analysts price this stock and the average price target is 200. They say it's 9% undervalued. Their current trailing 12-month revenue is $88 billion. The forecast is to hit $100 billion by the end of 2025. They are pretty leveraged, 240% debt to equity ratio. Debt of $42 billion, equity of $17 billion. They can easily cover their interest payments. They can cover the interest payments with their operating income 17 times. And it looks like each year their debt is higher than their equity. And it seems to be getting worse over time. Their debt to equity ratio is 130% in 2012. Now it's 240%. Dividend yield of 2.8%, 96% of their net income. So their dividends per share are a little higher than their earnings per share. If these two numbers were equal, their payout ratio would be 100%. You can see they raised their dividend each year. It was $2.15 per share in 2012, and it goes up each year. The forecast is for the number to be $5.60 per share by 2025. The yield stays in a pretty tight range. It's around 3% a year, and that's the forecast. By 2025, it's going to be 3%. The CEO's total compensation is $28 million. He's been with the company 5 years, and his salary is $1.6 million. In the past 12 months, there's been only insider selling, no buying. 74% of the company is held by institutions, 25% by the general public. Vanguard is the biggest shareholder at 9.5%, 130 million shares valued at $24 billion. And they've been around a long time, like Coca-Cola, since 1898. They actually started 5 years before that as Brad's Drinks in 1893. Their employee count is fairly steady. It's at its highest point, 315,000. They do employ a lot of people. And the ticker trades on the Nasdaq, Swiss, Mexican Bolsa, Deutsche Börse, Zicha, Santiago, London Stock Exchange, Brussels, Wiener Börse, EuroTLX, Bulgaria, BATS Europe, Buenos Aires, and Sao Paulo Bolsa. So hope you like the video format. Leave a like, subscribe, or comment below. If you want to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.